Hello, I'm Mark Abssy, Head of Indexing at Tematica Research, and welcome to the week ahead. So, what a week it was, right? We had the first full week of Trump 2.0. We closed out January, and we got ourselves set up for what seems to be, as they say euphemistically, an interesting February. So, quick recap on the week. DeepSeek news hit over the weekend. So, Monday opened, markets kind of freaked out because, of course, DeepSeek was upending everything. AI was dead, NVIDIA was dead, everything was dead. So, big sell off on Monday. That kind of came back, and throughout the week, that news became more and more tempered, right? And we did see stories about how, oh, well, DeepSeek's essentially just sitting on top of Chat GPT. And there was a story that I saw about how they had left certain drives open, so a bunch of their information and the source code and stuff was available. But the bottom line is that it turns out that DeepSeek, uh, not an OpenAI killer, um, perhaps an incremental change in advance, because it turns out that the hardware limitations that have been put on Chinese developers essentially force them to be much more efficient in their overall platform design and, of course, in their software development as well. So, again, while not a ChatGPT killer, perhaps something that can be learned from. So we'll see what happens there. Of course, in the middle of the week, we had the January Fed meeting, and as expected, the Fed did nothing, which is good because with all the craziness going on, markets were happy to have somebody actually doing what they said that they were going to do, especially when it comes to raising or cutting rates. Now, the one thing that the Fed did do is it maintained its position that it is, quote, data dependent. However, it threw into that mix that they really don't know what data is coming out and where kind of things are. So as they begin to understand this new environment, they will then start to add those elements into their, calculus of what to do with rates. Long and short of it is that they effectively called a freeze on any movements for the foreseeable future until things settle down enough that they can actually begin to chart progress. Okay. Now, at the end of the week, of course, tariffs, tariffs, tariffs. Come get your tariffs. Apparently, they are everywhere. So it was confirmed that indeed tariffs against Canada and Mexico are going into effect on Tuesday. On Friday, though, it was interesting because there was some news out of the White House that essentially, if any industry that wanted to basically show up, I don't know, at the White House at Mar-a-Lago, who knows, and negotiate their way out of 25%, they're welcome to do so. And over the weekend, we found out that neither Mexico nor Canada either heard that message or decided to act on that message, where we had Canadian Prime Minister Justin Trudeau make comments on Saturday evening, early evening, essentially saying, well, we're sad to see that you're taking these steps. Here are our steps. And so Canada is on track as well to initiate 25% tariffs on what turns out to be about 107, $108 billion of goods that cross the border here. And, it's almost like, depending on your point of view, it's almost like Trump is approaching tariffs from kind of like a village people, macho man approach, whereas Canada and Mexico are more of a, public enemy, you kill my dog, I'm going to slay your cat kind of thing. So, I mean, through the lens of history, it's interesting as we live through it right now. Yeah, it's going to be painful, and we're going to see inflation get hit. Now, to that end, there was some quick math that I did on the inflation thing with regards to oil. And I only chose oil because it's a discrete item, and the numbers that I found made for some fairly easy math. So essentially, we import about 60% of our oil from Canada. There's about another apparently 25% of oil that we send there for refinement, and then they send it back to us. So essentially, for argument's sake, let's say we're 85% of our energy with regards to oil anyway is either Canada based or somehow touches Canada. So we got a 10% VIG on 85% of our oil. That's essentially across the board for all of our oil an 8.5% increase in oil prices. The way CPI is calculated is they take the percentage of overall money spent on a component item, and that is the weight of it in the CPI index. CPI is really like an index of indexes of indexes. It's really kind of convoluted, but essentially what it boils down to is whatever the spend is on something, that can effectively be called the weight of it in the index. So, the kind of most current number that I could find about energy spend and GDP was from 2022, about 6.7%. So, if we take our 8.5% price increase, give it a 6.7% weight, we come up with about 57 basis points or 0.57%. And that would be kind of a raw figure, which would be the effective CPI bump from a 10% VIG on oil coming from Canada, right? So on its own, not a big number relative to where CPI is being printed recently. I mean, it's like a 20% hike, right? 20 to 30% hike. Well, no, a 20 to 25% hike, depending on, when you're looking at the numbers. So not insignificant. And again, that's just kind of the 10% VIG on oil. Now, the 25% VIG on the rest of it, honestly, there's so many items that are getting hit that it's difficult to actually play into what is going to happen there. But suffice it to say that if we're getting 0.5% bump from 10% on oil, and that's 6.7%, there's a lot of lumber. There's lots of automobile manufacture and OEM parts that are put together up in Canada that get shipped down here. There's lots of things, honestly, that go on. Not to mention, and I know I didn't see a ton of stories about this. I think I saw one or two comments, and it was by, for lack of a better way of saying it, kind of one of the more radical elements up in Canada. But they were quoted as saying, "Well, that's fine. What if we decide just not to sell you guys oil?" Clearly, that's a whole other thing, and would be a frankly drastic measure. But I mean, if I'm not saying it's not going to happen, but I'm not saying it's going to happen. We could see. We'll just have to see what happens there. Again, highly unrealistic, but let's be clear. Not all Canadians are as nice and polite as the Prime Minister there. But anyway, so tariffs are definitely happening. Tuesday's when they hit. Canada's retaliatory tariffs are going to come in stages. So there's going to be a section of items that are getting immediate tariffs on Tuesday, and then I think a 2 or 3 week window before the balance of those tariffs hit. And as was explained again in the Prime Minister's comments, to give companies and others time to make basically source other or find other sources for those items so that they can sidestep the tariffs. So next week, well, this week, really it's all about tariffs, right? Market's going to open on Monday. There's going to be lots of reaction to energy. There's going to be lots of reaction to, I believe, in consumer discretionary, which is where a lot of the autos sit. Tech, I think, is still going to be taking its lumps. Utilities, surprisingly, was actually the third worst sector last week. Tech was second, energy first, right? And utilities, in as much as we've been talking about nuclear energy and uranium with regards to data center build out and data energy needs, those have been slumping because of that same story, right? The DeepSeek not only hit chip makers, also hit a lot of these utilities that have been championing nuclear energy and some of these contracts that we've seen, like with Microsoft and Constellation Energy, to reopen 3 Mile Island. Google talking with other small form reactor manufacturers and those kinds of things. So there's still some dust to settle there. We will see what happens. So the coming week, it's all about tariffs. What is the impact going to be, and what can we expect going forward? Now, of course, a lot of those numbers we're not going to see until March, and those will be again preliminary numbers, but that's where people's heads are going to be at. Now, we will be getting some other figures. We're going to get PMI manufacturing numbers on Monday. Services will come on Wednesday. I don't think there's expected to be any great change in either of the numbers. As you may know, services have been kind of in expansion mode. Manufacturing has been in kind of a 48, 47 handle. With these numbers, with PMI numbers, of course, 50s your kind of demarcation line between growth and contraction. So anything below 50 indicates kind of shrinking. Anything above 50 indicates growth. Get factory orders and jolts on Tuesday. Again, like these are figures, and they're not like top line figures per se. Maybe jolts is, but again, the front part of the week is going to be the markets reacting, initial knee-jerk reactions to tariffs, and then as we work through the week, people will be doing a lot more work to figure out what those implications are, both for inflation and the economy. Thursday, initial and continuing claims, both are expected to tick a little higher. And then Friday, of course, we will get the unemployment figures for January. We'll get consumer credit also on Friday, and I think that's something that people are going to start taking a little more mind to because of the increased prices, right? And we've seen reports about increased delinquencies. We've seen reports about record levels of, essentially consumer borrowing with their credit cards. So it's going to be interesting to see where's that kind of tipping point, or where's that breaking point where people will say, you know what, I'm either not going to spend more because I can't, or it's not fiscally responsible, or we're just going to see delinquent rates really start to rise. The one thing that I thought was interesting, looking at the unemployment breakouts, one of the figures that's going to be released on Friday is something called the participation rate. And again, it's not a huge change, but I thought it was interesting. Pre-COVID, the participation rate ranged between kind of 62.5 to 63. Post-COVID, the figure is still range-bound, but it's actually range-bound, it seems like, between like 662 and 62.5. So it does seem like there's kind of a relatively new normal there in the participation rate. Again, I'm not being Chicken Little here, but it's just something to pay attention to about that. We're going to get more earnings through the week. Again, this earnings cycle so far has been pretty good. And so people are kind of leaning on that, I think. We are going to pay attention to, now that it turns out tariffs are a real thing, we will be paying attention to comments with regards to tariff impacts going forward. And of course, that is also going to play into what the markets are saying and doing. So that's pretty much it. Like I said, this coming week, tariffs. And there you have it. So have a good one, and we'll see you later.